Hello and welcome. Time is the only key to build our financial security. Much like time, effective planning and investing to help us secure our finance. To understand how, watch my videos, and if you like the contents, please subscribe to my channel and click the bell icon to get the latest update. Because in this channel, I will make you aware about each and every small topic related to financial planning, which will lead you to become a smart investor. But if you are new to my channel, please watch the previous video as this video is a continuation of previous one. So, back on the topic. Based on asset class, there are equity funds, debt funds, money market funds and hybrid funds. Equity funds. Equity funds primarily invest in stocks and hence go by the name of stock fund as well. They invest the money pooled in from various investors from different backgrounds into shares of different companies. The gain and losses associated with this fund depend slowly on how the invested share perform in the stock market. Also, equity funds have the potential to generate specific returns over a period. Hence, the risk associated with this fund also tends to be comparatively higher. Debt funds. Debt funds invest primarily in fixed income securities such as bonds, securities, and treasury bills. They invest in various fixed income instruments such as fixed maturity plans, gilt funds, liquid funds, short-term plans, long-term bonds, and monthly income plans, among others. Since the investments come with a fixed interest rate and maturity date, it can be a great option for passive investors looking for regular income with a minimal risk. Money market funds. Investors can also invest their money in money market, also known as capital market or cash market. The government runs it in association with banks, financial institutes and other corporations by issuing money market securities like bonds, dated securities and certificate of deposit among others. The fund manager invests your money and gives regular dividend in return. Opting for a short-term plan can lower the risk of investment considerably on such funds. Hybrid funds. As the name suggests, hybrid fund is an optimum mix of bonds and stock, the combination of equity funds and debt funds. The ratio can either be variable or fixed. In short, it can be the base of two mutual funds by distributing say 60% of asset in stocks and the rest in bonds or vice versa. Hybrid funds are suitable for investors looking to take more risk for debt plus returns benefit rather than sticking to lower or steady income schemes. Now, classification of mutual fund based on investment goals. There are growth funds, income funds, liquid funds, tax saving funds, aggressive growth funds, capital protection funds, fixed maturity funds and pension funds. Growth funds. Growth funds usually allocate a considerable portion in shares and growth sectors suitable for investors who have a surplus of idle money to be distributed in a riskier plan or are positive about the scheme. Income funds. Income funds belong to the family of debt mutual funds that distribute their money in a mix of bonds, certificate of deposits and securities among others. Liquid funds. Like income funds, liquid funds also belong to the debt fund category as they invest in debt instruments and money market with a tenure of up to 91 days. The maximum sum allowed to invest is rupees 10 lakhs. The highlighting feature that differentiates liquid funds from other debt funds is the way the net asset value is calculated. The net asset value of liquid funds is calculated for 365 days, while for other only business days are considerable. Tax Savings Fund. ELSS or Equity Linked Savings Scheme over the year have best rank among all categories of investor. Not only do they offer the benefit of wealth maximization while allowing you to save on taxes, but They also come with the lowest locking period of only 3 years. Investing predominantly in equity, they are known to generate non-tax return in the range 14 to 16%. These funds are best for salaried investors with a long-term investment horizon. Aggressive growth funds. Slightly on the riskier side when choosing what to invest in, the aggressive fund is designed to make monetary gains. Though susceptible to market volatility, one can decide on the fund as per the beta. Example, if the market shows a beta of 1, an aggressive fund will reflect a higher beta, say 1.10 or above. Capital protection funds. If protecting the principal is the priority, capital protection funds serve the purpose while earning relatively smaller returns. The fund manager invests a portion of money in bonds or certificates of deposits and the rest towards equities. Though the probability of incurring any loss is quite low, it is advised to stay invested for at least 3 years to safeguard your money, and also the returns are taxable. Fixed maturity funds. If you are uncomfortable with the debt market or related risks, fixed maturity plans which invest in bonds, securities, money market, etc. present a great opportunity. As a close-ended fund, its function on a fixed maturity period which could range from 1 month to 5 years. Pension funds. Putting away a portion of your income in a chosen pension fund to occur over a long period to secure you and your family's financial future after retiring from regular employment can take care of your most of the needs. So, in my next video, I will be talking about different types of mutual fund depending on risk and specialty. But if you have any doubt regarding this video, please feel free to ask me on the comment box and I will try to address the issue as soon as possible. Thanks for watching.